Providing personal advice to clients, financial advisors must meet the requirements of the Corporations Act 2001. Under Section 945A of the legislation, advisors need to have a reasonable basis for the advice they are providing to a client. Gold Seal's Claire Wyville-Plater says this requirement holds significant magnitude during the advice process for both the advisor and the client.
Well, in any professional relationship, there's a standard at which the professional should engage and should provide services. And the reason for that obviously is so that the client receives services at the level of professionalism that they are paying for and that they can reasonably expect.
FOS's Alison Maynard says the reasonable basis for advice standard is also linked to the ethical behaviour of an advisor.
When the job has been done properly of really investigating a person's personal circumstances, then you're well on the way to giving good advice and behaving ethically and responsibly in giving that advice.
There are 3 elements that an advisor must meet to show that they have a reasonable basis for the advice they are providing to the client.
Well, they're commonly described as know your client, which means obtaining enough information about your client to be able to properly advise. Know your product, which means understanding the products that you're recommending to the client to be able to ensure that they are suitable for the client. And then finally, making sure that the advice that you give, whether it be in relation to a product or another type of strategy, is suitable to meet the client's objectives.
To comply with the Know Your Client rule, an advisor needs to collect enough information about the individual to have a good understanding of their personal circumstances so that they're able to formulate a strategy that meets the client's needs, goals and objectives. Wyville-Plater says the extent of the information that they collect depends on the complexity of the situation and of the client's needs.
It can also depend, of course, on the client's financial literacy, because if the client doesn't have a good understanding of financial concepts, they're probably going to find it more difficult to explain to the advisor what they need and also potentially to understand the advice the advisor gives.
A comprehensive fact find, accompanied by robust file notes that document discussions that have been held between the client and the advisor, is essential.
We'd expect to see good documentation around what the client's goals and objectives are, and also what you understand of their personal circumstances and what you might objectively see as their needs.
In addition, Maynard says advisors should be conducting reality checking of a client's objectives.
Because if a person has unreasonable goals and objectives and doesn't necessarily have the resources to achieve those objectives, then you need to have some good conversations around, well, what is achievable and what of their goals they may need to modify in the context of that discussion.
Maynard explains advisors should also articulate the client's objectives in words the individual has used, as this demonstrates the advisor has heard and understood the client's goals in seeking out financial advice.
I don't think clients come in to see an advisor saying, well, look, I'd like a well-diversified portfolio of blue chip shares together with some suitable property investments in property developments. That's not what they come in and say. They come in and say, look, I want some advice on retirement, and I'm seeking to have a reasonable income in my retirement. How can you help me do that? Or whatever the case may be.
Within the Know Your Client requirement, it stipulates an advisor must make reasonable inquiries about a client's relevant personal circumstances. Wyville-Plater says reasonable depends on what the client has asked the advisor to do.
But if a client hasn't come to you and asked you for advice about their financial situation or their superannuation, but only the insurance, you don't need to inquire into those other circumstances because they're not relevant to the advice the client has asked for.
To satisfy the Know Your Client rule, Maynard explains there should be robust discussions around risk and how the client's risk profile fits in with the advisor's recommendations.
Make sure that your strategy and asset allocation is in accordance with your own risk profiling. If it isn't, then we'd want to see good explanations as to why. And also, risk profiling tools are only tools. There must be very good discussions around risk.
To comply with the Know Your Product rule, an advisor must understand the products that they are recommending to the client.
Don't recommend products that you don't understand, and you must clearly be able to explain the risks of the product and the advantages of the product in your statement of advice in language that the client can understand.
Before advisors hand over a PDS to a client, Maynard flagged there must be a discussion of this product selection in the SOA.
Don't cut and paste PDS risk disclosures into the statement of advice. It's not meeting your obligations. Demonstrate that your understanding of the products by putting the words into the statement of advice that you have used to explain the product to your client verbally.
To ensure the advice provided to the client is appropriate, an advisor needs to ensure they select an investment product that is suitable for the client's needs and objectives.
We would want to see good explanations in the statement of advice as to why particular strategies and products have been selected and why others have been rejected. Particularly where a client is in an existing product and you are moving the client from an existing product or strategy into a different product, then there needs to be very good explanation as to what are the advantages of making that shift.
Maynard urged advisors to avoid providing cookie-cutter advice to clients.
You can't give the same advice and strategy to everyone who works in your door, and it becomes pretty apparent on examining the documents and the statements of advice that that's what's been going on.
If an advisor fails to have a reasonable basis for the advice they provide to a client, ASIC has the power to prosecute or take regulatory action against them. Wyville Plater says ASIC will enforce this standard, particularly if there are a large number of consumers who have suffered a loss as a result of the inappropriate advice they have received from an advisor. ASIC's enforcement of the reasonable basis for advice standard on an AFS licensee or an authorised representative of an AFS licensee may involve enforceable undertakings, suspension of an AFS licence, banning an authorised representative from providing financial advice services, and stipulating supervision and education requirements on the licensee or advisor. Meanwhile, the proposed FOFA reforms will impact the reasonable basis for advice standard, with Wyville Plater noting ASIC will be much more rigid in its regulation of the best interest duty.
Instead of just the three that know your client, know your product, appropriate advice, there are now a considerable number of steps that ASIC has laid out must be followed.
When complaints against an advisor have failed to be resolved at the internal dispute resolution level, the next step is to escalate it to an external dispute resolution scheme, such as FOS or the Credit Ombudsman Service Limited, to address. Maynard says FOS receives a large number of disputes where a lack of establishing a reasonable basis for advice is part of the issue.
In the investments area of FOS, the most complained about issue is the appropriateness of advice. So it's a significant issue for us. When a dispute comes to an ombudsman or an ombudsman sitting with a panel for a decision, then about 55% of the decisions are going in favour of the clients who complain. So I suppose those figures tell a story that there is definitely room for improvement in the industry in the appropriateness, in giving appropriate advice.
When it comes to advisors showing they have complied with all elements of the reasonable basis for advice requirement, Wyville Plater says one of the best ways is to use their SOA properly.
Set out, number one, the information, the key and relevant information they've collected. Don't have to put it all in, but just the bits that are relevant. Number two, the strategies that they've considered for the client. In other words, what types of scenarios they've considered. The conclusion they've come to in terms of the advice that they've given and what they recommend to the client.
The third element, which Wyville Plater highlighted is often absent in SOAs, is an explanation of why the advisor thinks that the recommendation is going to be suitable for the client.
In other words, how it is that the recommendation is going to meet the client's objectives. And that's the bit we often don't see in a statement of advice. And if you think about it, it's probably the most important piece because it's connecting it's making the link between the client's objectives and the advice that's been given.